In this example, I'm going to walk you through how we're going to be able to analyze business transactions while still keeping our accounting equation in balance. As you can see at top here, here's our accounting equation. So our assets have to equal our liabilities plus our stockholders' equity. And that accounting equation always has to stay in balance. So one thing to keep in mind when we're going to start going through each of these business transactions is that every business transaction must impact at least two accounts. So it can impact 3 or 4 or 5, but it can never impact less than 2. And again, that is because our accounting equation always has to stay in balance. Another thing to always pay attention to when you're analyzing these business transactions is to really pay close attention to wording. So anytime you see an account name, and again, you see all of our account names listed at top here, anytime you see an account name listed in a transaction, we automatically know that that account has to be impacted. The third thing to keep in mind is anytime you see the word paid, paid means that I'm paying something in cash. So anytime we see the word paid, we automatically know one of our cash is one of our two accounts that are going to be impacted. All right, so they tell us that our Amy Austin is one of our key owners, and she established an insurance agency on March 1st and completed the following transactions. So she opened a business bank account with a deposit of $50,000 in exchange for common stock. So common stock, we see that common stock is one of the account names that we have here. So we know common stock is going to have to be impacted. And what is the business gaining? So the business is gaining $50,000. So we're going to put in our $50,000 into our cash as a positive. And we now have more owners in our business. So our common stock has increased. So remember, our stockholders are those that have been able to invest into the business in terms of exchanging assets for ownership. Next one, we've purchased supplies, and here's a key phrase you're going to see often, on account. So when we see that we've made a purchase on account, it means that we didn't actually pay cash for those supplies today. So again, we don't see that word paid. So that means that we're going to owe $4,000 sometime in the future for the supplies that we already have in our possession. So kind of a little trick that you can utilize is when the last word is account and the first letter of the first word is P, we're dealing with accounts payable. So we're purchasing it on account. So supplies, when I go out and I purchase supplies, those are assets to me. They do not become an expense to my business until I use them. So remember, the definition of an expense is any asset that we've used to help run and operate our business. We haven't used those supplies yet. We simply went out and bought them, and we owe that money sometime in the future for those supplies. So they want us to do a balance here. So we have $50,000 in cash. We have $4,000 in supplies. We owe $4,000 in liabilities, and we have ownership of $50,000 in common stock. So if we take a look, we've got $54,000 on our asset side, and that always has to equal our liabilities plus our stockholders' equity, which it does. We have $54,000 on the other side. In C, it says we paid creditors on account for $2,300. So paid, as I mentioned, every time we see the word paid, we know that we're dealing with cash. And if I paid out cash, I certainly have less of it. And there's that phrase again, on account. So creditors are people that we owe money to. So again, you can use that same little trick. Last word is account. First letter of the first word is P. So we're dealing with accounts payable. So I owed the creditors $4,000 and I just paid them $2,300. So I owe them less money in the future. So think about paying a credit card statement. We want to see that balance go down. So we're going to update our balance here. So now we have $47,700 in cash, still have $4,000 in supplies, but we don't owe as much money anymore. We only owe $1,700 in accounts payable, and we still have our $50,000 in common stock. In D, it says we received cash. So if we received cash, that means cash is going to be involved. We see that name right there. And we've received it, which means that we certainly have more of it. So we got $13,800 coming in for cash. And then we got to ask ourselves the question, why? Why are we receiving the cash? Well, it says that we received cash from fees earned on insurance commissions. So again, we look at our account names that we have, and we have a fees earned account. So remember, fees earned is kind of falls under that big stockholder equity umbrella, and it's classified as a revenue. So a revenue represents what we have earned the rights to an asset for providing a service. So I charge my customers a fee for this insurance commission that I'm providing insurance services for them, and I've earned it because I've actually provided the service. So I get to increase my revenues. I've earned the right to $13,800 from my customers because I've done something for them. So we're going to update our balance yet again for each one of our accounts. And we see that our accounting equation still is in balance. And again, notice that every transaction is impacting at least 2 accounts, and that has to happen every time. Next one, it says we paid rent on the office and equipment for the month of $5,000. So keyword is paid. Every time we see the word paid, we know that cash is going to be involved. And when I pay out cash, I have less of it. And then we ask, well, what did we pay money for? We paid money for rent. So we have a rent expense account. And remember, our expense accounts represent assets that we've used to help run and operate our business. So I used an asset, specifically cash, of $5,000 to pay for the rent of our office space. So very hard for me to run and operate my business if I don't have an office space for us. So we're going to update our balance yet again. So our cash has gone down. Our other accounts have stayed the same from the previous time. And now we have $5,000 in rent. Notice that we put that in as a minus sign because we know our expenses actually bring down the value of net income, which therefore brings down the value of our stockholders overall. So it has a negative impact because assets are leaving our business. So unlike common stock or assets were coming into our business, it added value. When assets leave our business, it brings down the value. On F, it says we paid an automobile expense for the month of $1,150 and a miscellaneous expense of $300. So again, we see the word paid, we know cash is involved, and we see 2 other accounts. We've got automobile expenses, which we see over here, and we've got miscellaneous, which again we see over here. So when we're looking at what we've paid in total, we've paid $1,450 in cash, but that has impacted 2 of our other accounts. My accounting equation still balances. My assets are dropping by $1,450. And in total for this transaction, my equity is also going down by that same amount. Remember, every transaction has to impact at least 2 accounts, but it can impact more than 2, which we see here in this transaction. So we update our balances once again. We got $55,050 left in our cash. Supplies are still at $4,000. We got $1,700 in our accounts payable. $50,000 in common stock. We've earned $13,800 in revenues by providing services to our customers. And then we've used up some assets to help run and operate our business, which we know we record as expenses. In G, we paid office salaries of $2,500. So again, we've paid, so $2,500 comes out. And what we are paying for, they told us, is our office salaries. So our employees are an expense to us. They help us run and operate our business. And by doing that, we owe them money. We're using up assets to give them their money for their salary for that period of time. So our cash has come down a little bit more. And again, we've used up some of that cash to help run and operate our business for that time period. And make sure you put in those negative signs when you're doing those balances as well for your expenses. In H, it says we determined that the cost of supplies on hand was $2,700. Therefore, the cost of supplies used was $1,300. So, as I mentioned, the definition of an expense is any asset that we have used to run and operate our business. So, for example, in the previous one, we used $2,500 in cash, which is an asset, to pay our employees. In this case, we're using a different asset. We're using supplies. So we're using up some of those supplies, so whether those are pens, pencils, paper, whatever the case may be, we're using some of that up to help run and operate the business. So we have to reduce our supplies, not by what's on hand, but what was used. So just because you see those two numbers doesn't mean both numbers are going to be impacted in that transaction. So we've used $1,300 in supplies, so that means I have less supplies by $1,300, and I've used them so they become an expense for my business. So remember, your accounting equation has to balance. So I can't put 2,700 here and 13 here. We wouldn't balance. So now when I update my balances, what we see is that my supplies now shows what is considered the on-hand amount. On-hand means how much of that asset we still own. Think of it like you can still put your hands on it. It's still there for us. So we reduce it by how much we've used because that is what becomes our expense. It represents how much we've used to help run and operate our business. Next one, it says we billed insurance companies for sales commissions earned of $12,500. So we billed. So billed, it means I didn't get the money today, which is different than what we had here, right? We received cash for those fees earned. We're not getting those today. So we're billing our customers. So that means I need to wait to receive that money sometime in the future. So we're going to increase our accounts receivable by that $12,500. But the key thing is that we've actually earned it. And here is that keyword earned. And we see over here our fees earned. We record our revenue when we earn it, regardless of when we actually get the cash for it. So I've earned the right to get $12,500 sometime in the future for something I've already done. So it becomes an accounts receivable. We're going to wait to receive it, but I've already earned it. I don't have to do anything else for those customers to get that $12,500. So we update our balances one more time. And you see that we're starting to fill in those balances. All right, last transaction, it says we paid a dividend of $3,900. So paid, we know we pay everything in cash, so our cash goes down by $3,900. And we're paying a dividend. So a dividend is when we give something back to our stockholders, kind of as a way of saying thank you for investing into us. So we update our balances one more time. to get our ending balances for the period. And we'll see that if we add up all that, we would have our accounting equation still in balance for the period. So again, key thing, at least 2 accounts have to be impacted, and really pay very close attention to wording. That's going to help you a lot.